Hello everybody, welcome back to our final panel of the morning. I'm Andrew Keane from Edison. It's my great pleasure to host a panel this morning on decarbonisation with a really interesting selection of people from this sector. Decarbonisation is a massive growth sector right across a number of different economic uses. This is a reminder, in 2015, just short of 10 years ago, was the Paris Climate Agreement, where there was a broad international agreement to limit global warming to much less than 2 degrees, preferably 1.5 degrees. This was from a baseline that temperatures had already risen 1 degree from pre-industrial levels. Well, 2023 was the first year where global warming resulted in a 1.5 degree increase across an entire year, according to EU estimates. And a recent survey from the Intergovernmental Panel on Climate Change indicated that only 6% of climate scientists believed that 1.5 degrees would be the limit that would be met. 80% foresaw at least a 2.5 degree warming, and almost half surveyed anticipated at least 3 degrees. So the environment, for the environment, so to speak, has not changed, and this is creating naturally huge environments where solutions need to be found. Last year, it's great to host a decarbonisation panel with no electric vehicles. Electric vehicles are only part of the solution. They did surge almost 35% last year to 14 million EV sales globally. But there has to be dozens of technology solutions, not only in transportation, but energy generation, energy transmission, energy storage, fuel systems, decarbonisation of shipping, alternative energy, and this is going to be an enormous challenge and an enormous growth area. Installation of global renewable power increased by nearly half in 2023. Huge amount of that naturally was in China. And normally equity markets like growth, certainly they do in electric vehicles, but they don't in alternatives at the moment. MSCI Global Alternative Energy Index fell 27% in 2023. And the S&P Global Clean Energy Index fell 20%. So there's a really interesting dichotomy here between high growth, high need for growth, and the way that investment markets like to value that and fund that. So really interesting panel. We have Ross Driver, Managing Director of Foresight, Ben Jones, Chief Economist at Ørsted, Ben Richardson, CEO of SulNOx, and James Smith, Fund Manager of Premier Miton Global Renewables Trust. So a really interesting and diverse cross-section across this space. The format for this particular panel will be I'll ask each of the participants to give an overview of themselves and their firms. We'll then focus on some Q&A, and then we'll do some more audience as well. So with that, I'll hand over to Ross for an intro.
Certainly. Thanks, Andrew. And good morning still, everybody. I'm Ross Driver. I work for Foresight Group. We're a sustainability-focused asset manager headquartered here in London in the Shard. We have about 12.5 billion of assets under management. We also have offices across Europe and over in Australia as well, and run, I think it's up to about 16 funds now focused on predominantly the energy transition in that kind of way, in different markets. So my primary role is that I am the fund manager of the Foresight Solar Fund. We are one of the original listed FTSE 250 listed vehicles that invests in solar and with an element of battery storage in it as well. So we launched in 2013. We had our 10-year anniversary in October last year, celebrated at the LSE. And I think it's fair to say that things have changed quite a bit in the space in that time. When the fund started back then, we were investing in predominantly just UK rock-backed solar assets. We built up a large portfolio here in the UK. We've subsequently moved to Australia, where they were having subsidies for backing solar there as well. Then built out a portfolio in Spain, and latterly moved into a small allocation into battery storage But I think where we're at now is we're going earlier and say solar's a well-established technology that's been around for a long time, it's very stable, can offer really good quality returns, which also makes it very attractive and potentially drives down the returns, particularly in the operational phase. So we actually had our own capital markets day yesterday, and one of the messages that we were putting out from that is we're going earlier in the food chain on this. We're going down to now work with developers to go to the really early stage of bringing projects through and looking to add, alongside what's a sort of high quality yield for the fund, also looking to add an element of capital growth to that as well. Because I'm sure we won't get through it, and Andrew won't let us to get through this afternoon, is the macroeconomic outlook at the moment has been very challenging for the listed funds and everyone in our space. So we're all trading at discounts to NAV at the moment, and I think there's a key question there about how do you make this asset class really attractive for investors with large amounts of money to bring into this space so that we can help to drive the energy transition going forward. So, thoughts on that?
Great. Thanks, Andrew. Good morning, everyone. My name's Ben Jones. I'm Chief Economist at Ørsted. For those of you who have not come across us, we're a leading Danish listed renewable energy developer. We're an offshore wind specialist. We're owners of around 8.2 gigawatts of capacity globally. Our principal markets are in the UK, Ireland, Benelux, and the Nordics. But we have interests in Taiwan, and we're building one of the first offshore wind facilities in the US. So we're diversified across jurisdictions, but we have small onshore businesses, but we're principally offshore wind specialists. Our genesis was from the Danish National Oil and Gas Company, the then Dong Energy. We're a classic kind of MBA textbook example of a company undertaking a rapid and focused strategic pivot away from the fossil sector and into the renewables domain. So we are the original growth stock in some sense. We continue to be committed to a growth outlook reflecting the priority of the energy transition that Andrew spoke about. We currently have around 6.5 gigawatts under construction, 2 further phases in Taiwan. Hornsea 3, so the third phase of our Hornsea construction, I think 2.85 gigawatts of further capacity, so that'll be the single largest wind farm in the world, and it will take the total capacity of that facility to nigh on 9 gigawatts. So that's truly immense, I think, in terms of scale. So yeah, that's an overview of the business, and very much looking forward to the panel.
Thanks. Great, thank you. So good morning, everybody. My name is Ben Richardson. I'm the Chief Executive Officer at SulNOx Group PLC. SulNOx is an Aquis listed stock, and we are very much an energy transition solution company. So the company ourselves, we invent all natural, biodegradable, green tech technologies which reduce the consumption of fossil fuels. And we do this by improving combustion and indeed adding lubricity and detergency to improve the effectiveness of all internal combustion engines. And the product works for all petrol, all diesel, all marine fuels, all up and coming biofuels, both first and second generation. And in tests around the world in multiple industries, including mining and shipping, and indeed in our own petrol stations, SulNOx will reduce fuel consumption by 10 to 15%. We will also dramatically reduce the emissions that come out of the back. When you think about black smoke, that's just unburnt fuel. SulNOx will reduce that by as much as 50%. So we are a solution to the world where unfortunately we live today, where fossil fuels are very much in demand. And as we look at the world and see the developing countries burning more and more fossil fuels, despite everyone's best intentions and all of our support to increase renewables, we will see fossil fuels continue to be used. And we are the solution today, very simple, easy to use, non-capex product, which can reduce fossil fuel consumption and deal with today's problems so that the issues that we're all going to face tomorrow that you mentioned, Andrew, the 2.5% plus increasing in, 2.5 degrees increasing in temperature is less of a problem. And with that, I'll look forward to the panel and pass over to James.
Good morning, everyone. My name is James Smith. I'm the fund manager of the Premier Miton Global Renewables Trust and have been since May 2012. And the trust operates a global portfolio of renewable energy companies of differing types, but mainly looking at it from an infrastructure point of view. So we're after companies that produce and sell renewable energy, but also companies that facilitate the delivery of that energy to customers. So we would also include within our remit electricity grids, for example, or battery storage companies, and a few other rather newer ideas that we may come on to later. And what the trust is trying to achieve for investors is essentially a one-stop shop for anyone who wants a global renewable energy exposure, but primarily from an infrastructure point of view, so not through owning things like wind turbine manufacturing companies, which of course are competitive activity. We're mainly looking for companies with contracted and reliable, highly visible revenue streams. And the interesting thing is that we try and achieve this mix of growth and income by investing in different sorts of renewable companies. So at one end you'd have the renewable energy investment companies, like Foresight Solar, for example, that don't tend to do a great deal of their business in the actual upfront development work, but we also own renewable energy development companies. Ørsted would be obviously one of the larger examples in the world, whereby a substantial proportion of what they do is that upfront development work, trying to find places for projects, specifying the project, getting the planning permissions, the environmental permits, the grid, and then eventually building and owning the asset. So yeah, that's effectively it.
Thanks. I did sort of circulate a few broad themes for us to talk about before we open it up to a general discussion, and I think these themes sort of fell generally into growth, whether that growth environment is there, and then funding that growth and different models of that, and then finally whether or not the investment market correctly values that growth as well. But just on the first issue of growth, and I guess it's a question for Ross and the two Bens to start with. Is it policy or is it competitiveness that is now driving demand for renewables? There's been a significant fall in capital intensity, in operating costs, those kind of things. What's creating some of the surge now?
Want me to start on that?
Yep.
So I think looking at the sort of key markets that we look at across in Europe, and if you're talking from a political sense and the regulatory environment as well, it's something we were talking about at our event yesterday with an economist, that actually it's in some ways government setting the ground rules for this and then getting out of the way. We know that although there's been a bit of a drop off in investment here in the UK, and none of the maybe the political background doesn't necessarily help that, with some the high chance of a change in government coming up later this year. But we've also got things such as the REMA, the review of the electricity market arrangements, where we're still not sure exactly what the boundaries and what the goalposts for the regulation of the market are going to look like here for the UK. So there've been some of the broader sort of possibly more disruptive options for that have been ruled out, but we still don't know. We could move to a situation where we've got regional-based pricing. So the market is split into different price sections, like it is in the Nordics in terms of the market. So there's uncertainty there, and what you're actually seeing, and we're seeing across Europe in the different markets that we look at as the wider group, you have a lot of countries looking to position. So we just closed last week a new opportunity development pipeline actually for battery storage in Spain, where we see that the government is trying to incentivise that. We know that the Italian state is trying to really incentivise that. They want to get 25 billion into battery storage in Italy to help balance their grid. So I think one of the biggest things that we see, if you've got strong, stable markets with good law, regulatory regimes such as the UK is, and we still see a lot of demand for high quality assets here in the UK, what will help is the government giving clarity on those guidelines, but also the regulator as well, I would say.
Look, I think it's both, and I think the balance of those kind of collective drivers is shifting. It depends on the market, depends on the technologies you've spoken about. and I think it's changing over time as well. And they're not independent. I mean, it seems to be sort of a favourite kind of thought process or argument for investors in the sector is to sort of criticise policy. You know, oh, it's not intensive enough. You know, we're not moving fast enough, etc., etc. I started my career in policy, so I'm sensitive to the topic. But I think if you stand back for a minute, you can argue about the coherence of the frameworks, etc., etc. But what policymakers have done in the last 15, 20 years is throw a battery of instruments at the sector, and that really has accounted, I think, for a lot of the innovation, a lot of the R&D, and a lot of the capacity growth. Right? They've pulled tax frameworks, tax credits, carbon markets, implicit regulations on vehicles and on flue pipes, you name it. Basically, if you've polluted carbon, other pollutants, you've seen regulation tighten and tighten and tighten. And actually, I think that picture's often lost when we talk about the next iteration of market reform. Actually, what we've seen is an accumulated ratcheting up of policy measures. And actually, many of the costs and much of the intensity of those measures is actually hidden, I think. You can measure a carbon price, but it's far harder to estimate the cost of complying with a tailpipe regulation in the vehicle sector. And these kind of measures are clearly quite critical for the way the electric vehicle market emerges, for example. I think kind of unlike what, to a greater degree, I think the cost and scale fundamentals of the offshore market make it, I think, intrinsically a little bit more policy sensitive than perhaps the solar sector. I think that's probably a fair statement. It's bigger. It costs more upfront. You need, I think, intrinsically a little bit more support, a little bit more differentiated support from policymakers, and we've been affected by the construction cost and the inflation pulse that many sectors have been exposed to, and I think that is kind of forcing policymakers to review their standpoints in terms of the level and intensity of some of the key support measures. And we're seeing that in some of these adjustments flow through in the UK, in some of the East Coast states, in the US and elsewhere. So I think as a sector, I see one that's grown incredibly quickly and is kind of pausing for breath. And I think our management, Maz Nipper, our CEO, and others have been quite clear with the investor community that actually, we probably need to see a little bit more from policymakers in terms of that intensity of support in order that we kickstart the next phase. But we're confident that it's coming, and we're really committed to it. You can see the growth pipeline that we've committed to. So we're optimistic. I think where the next phase of innovation goes will be interesting. We can see the yields improving in solar. It's interesting to think about what the next generation of yields might look like. Equally, battery storage. We're seeing capture prices falling and under pressure for a greater proportion of the saleable hours, and with that brings the need for reform in the flexibility market. So I think really, if I'm looking to innovation as a driver, maybe I see it perhaps a little bit less dynamic in the wind sector, and perhaps a little bit more in complementary sectors like batteries.
Brilliant.
Ben, we were talking earlier. You've got a specific end use which is quite vulnerable to regulation.
Yes,
particularly marine shipping.
Yeah, that's right. So I'm agreeing with Ben. It needs to be both carrot and stick. I think the problem with regulation is it's often a blunt tool that's hard to implement. And if we look at shipping, we now have the carbon intensity indicator, which causes ship owners to pay for 40% of their emissions of greenhouse gases in the European Union. The problem with that is it's punitive, but there is no real alternative available. And what we've got to also do is incentivise them through products like SulNOx, which can have an immediate reduction in fossil fuel. And how would you do that? Well, I think you don't just have the regulatory carbon market, you have to make it easy for all of us to contribute to the bigger cause. And I think that's something where we need to get hold of. So if I'm a fuel user, I'm burning 10% less fossil fuels and emitting 50% less emissions, I should be able to gain some benefit from that. And I think that carrot, I've just got a Labrador puppy, so I know the carrot is far mightier than anything else. That incentive is the same for the market. And we are all innovative. We've got money to spend on innovation, but we just don't get that encouragement in the right direction for us all to sit up and behave.
Quick question on that. I mean, if all of you had one choice for a policy change, what would it be? Be a carbon price? Would it be a mandating of renewable levels? Is there a magic bullet that changes it, or would you trade that all for just a really high gas price?
It doesn't work. The pricing side doesn't work. I mean, if I look across the world, certainly in the UK, the fuel is the fuel. You pay it regardless, and the consumer pays, right? So you have to. It's just a fact of life. Versus in Africa, actually, where every drop and every penny costs or matters, so they're far more in tune with that. So it does vary across the world, but I think whatever you do to prices, there is no viable alternative. That is what we need to try and incentivise to happen.
Tough question.
I'm sorry.
Oh, so what do you want for Christmas? Look, I think I'd probably centre on the UK, just given the nature of our portfolio and our focus. Clearly, the contract for difference has been a critical market transformatory policy. So clearly, the terms around that would be high up the shopping list. But if I think about some of the drivers in, can I have two?
Okay.
Yeah, I'm greedy. What can I say? So I think if I had a second, I think it would probably be a capital subsidy on storage.
Okay. Do you want a Christmas present?
Well, I'll still come back to I think actually for the solar side, I'm focusing on the UK as well. I think the ambition, it's been there, it's been wobbled around a bit to quintuple the level of solar here in the UK. So there is that, there's the CFDs as well, but I'd say from our side, I think it'd be great to have that as an option. We don't see it as the only route to it.
Sure.
So actually I think we could also do it through long-term PPAs, and actually we like the view of the corporate PPAs as well. We see a lot of those coming through for new build solar. I think we as that kind of investor would like that opportunity and the ability to have some exposure to the merchant price as well. Completely agree with you on for the offshore wind. I think CFDs have completely pushed that market forward, and to have a good allocation in that for solar as well would be great. But I think if there could be more certainty, it would remove the roadblocks to getting through and some of the planning. There was some good progress actually under the Boris Johnson administration on planning and things like that, but a bit more certainty on the market. I'm a career infrastructure investor, so we're just looking for, just give us that clarity, the market will come in and deliver it. So that's where we are.
I have some questions on funding and dividends, but James, I'm conscious I haven't asked you a question. Would you like a Christmas present? You're across technology, you're across firms.
Yeah.
If you had something within your portfolio that would make the largest change, what do you think it would be?
I think one thing that we're currently looking at, and it affects Ross quite a lot as well, is the way that investment companies are forced to account for costs, and we're hoping that will change before too long. And the way it works at the moment, we're the only country in Europe that interprets EU law in the way that we do. Now, effectively, for my trust, within my capital structure, I also have some ZDP shares, if any of you are familiar with that instrument. But effectively, I'm forced to lump the finance cost of those ZDP shares within my operating costs as though they were part of the management fee, which doesn't really make any sense because, of course, it ignores the return that the investor gets from the assets that are owned within the trust that have been financed by the ZDP shares. And of course, similar thing, the way that the renewable energy investment companies are forced to account for costs is totally different than if they were just a normal renewable energy development company, for instance. So, you know, Foresight Solar could reconstitute themselves into a standard corporate structure, which would mean that, without any change in their actual business or assets, the average wealth manager in the street would be much more likely to hold them, because he wouldn't have to say to his clients that the costs have increased. So it just doesn't make any sense. So that's what I'd like to see change.
Coming on to the issue of funding, there's lots of different models, you know, in terms of being integrated publicly listed firms, being listed investment trusts, being early stage technology firms, and they've all got their strengths and weaknesses. Ross, one of the things we've talked about before is the difficulty in the way that the market is valuing assets now and then driving discounts to NAVs. How has that changed your strategy in terms of funding growth and bringing growth through?
Well, I think that growth is the main question. It's something we were talking about yesterday with our investors, and the biggest challenge at the moment. I think it's the macro backdrop. We're in the most challenging point that there's been for the investment trust sector since its inception 10 years ago, and it's really been driven by the rapid rise, the steepest rise in gilt rates that we've seen in 40 years, in a generation, and markets are adjusting to that. So there have been, when you talk about it with NAVs and values, there's been transactions that have taken place in the market, large portfolios of solar that transacted that have proven the price, and still it's not enough for investors at the moment. I think the key thing when you look at it, and we've got some charts, if you go back to the last 10 years, and I think James will probably be quite familiar with this as well, a lot of us in the renewable sector, we got off by buying operational assets and offering a good quality yield of that. And if you were getting even sort of 4, 5, 6%, that was a real good spread against what the gilt rates were offering that were near zero and actually were negative in real terms. So you got a really positive spread there. Now, as that's all been eroded in the last couple of years, investors aren't getting that same kind of spread, and that's why it's made sense to go back to looking to fixed income products as well. But I think what the sector has to see, you can prove the valuations. Those coming through, I think there's more of an acceptance now that that's there, but investors still saying, well, it's not enough for us at the moment. Even though we're saying they're sort of 20-25% discount, it's an absolute bargain at the moment. So the way we're looking at it is that I don't think we're going to be able to go back to business as usual from before. I think those times are gone in terms of just being a yield co-play. I think it's going to be a question of offering investors a strong quality yield with the option for a modest level of capital growth over time as well. And that's where we see it. I think migrating more into the down the food chain, into the domain of some of the others, going to more development, but actually using and partnering up with developers who are the specialists of that to bring projects through as an earlier stage. And I think rather than just being purely a long-term holder of assets yielding off, what we'll be doing is trading in those assets more. So sort of bringing projects through to a consented state, you've got a valuable asset, you can sell that and recycle some capital growth for investors as well, or also sell down long-standing assets like we've already sold down. First assets we ever sold was half of our Spanish portfolio last year at a good premium. So I think it's got to be more than just the income priority.
And Ben, for SulNOx, I mean, there are early stage technology firms right across the energy space, and you've seen it in things like hydrogen. Yes. and very other things. The investors haven't necessarily been very attracted to technology risk. No. Or innovation.
And I was at a climate summit with Zach Goldsmith the other day, and we had this exact discussion. I think the pension funds and indeed family offices and everyone else, they're now everything is decided by consensus and by not by one decision maker anymore, and that always causes caution. I think there needs to be some flexibility, certainly for the pension fund, to bring these new technologies like SulNOx through. You can get the VC money, then there's a gap, and then you're a pension fund. And if you're somewhere like us in the middle, we could grow hugely if we had that gap funding, as I would call it. And it's just not available. A lawyer will not say, on a pension fund, I'll sign off on that risk. You are absolutely bound to make the investments that are going to make you the money without any risk. And it's so hard for up-and-coming SMEs to get that secondary funding.
James, you invest across the sector. I know you've got yield cos and developers. I mean, do you actually think the industry should be, even parts of it, should be paying out dividends, or should be looking at yield cos, or should they be reinvesting?
Well, different investors want different things out of their investment. Some investors, maybe at different stages of their life. Some may be retired, some may want income, some may want capital. And that's the beauty of this sector. Whatever kind of return you want, you can find a company that will deliver it. So, yeah, I guess whatever people want. I think, come back to Ross's point on the income, the market has become overly fixated with interest rates. So the income that people perhaps want is maybe higher, but the market has completely ignored all the other benefits that the sector is currently going through, like growth, for instance. And if we look over the past 10 years or so, global renewable energy production has grown by over 12% per year, consistently. And there aren't many sectors in the world delivering that level of growth.
It's fundamentally a very long-dated revenue streams in a lot of these assets because of their size, but that inflation linkage often isn't very visible within asset sets. But I know you've certainly done a lot to highlight that. But is that something that do you think people think about, that there's a counterpoint to the rise in base rates?
Yeah, a lot of my investors ask how much of the portfolio is linked to inflation. It's something that perhaps they didn't used to ask, but since we've had high inflation, it's now very much on everyone's radar. And if we see many of the renewable energy investment companies, for instance, they've been able to increase their dividends at rates that perhaps, if you'd asked them 5-6 years ago, would we be having 5, 6, 7% dividend increases, they'd have probably said no. But because of the inflation linkages in their assets, they've been able to deliver that level of dividend increase. So to own those companies, you are to a large extent protected from inflation. And if you were to look at their share prices, the market seems to be, to an extent, missing that.
And do you think that's a thing in large-scale offshore wind as well, in terms of protecting revenue streams in those ways?
Look, we've got a hybrid model as well.
Yep.
We're focused on growth, which we achieve through a farm down model. So we take early stage interest and we sell down after developing, and then we keep a piece of the equity for a yield story. So I think we see value in that model. Clearly, the exposures from inflation are different through those two stages of value, right? I think as a developer, clearly we have a high preference for index-linked terms. It's an attractive feature of the US, of the UK. There's some evidence of a shift towards index-linked kind of policy terms in some of the US states. We see it supporting our interest in Baltica 1, which is a project in Poland, for example. So look, I think on the downstream, on the yield side, a little bit more market specific. It really depends on the returns and the structure of the regulations that determine the prices, right? But I think I tend to agree that there's something missing, in terms of the way some of the investors are valuing the yield component in particular.
And one last question before I open it up to the floor more broadly. The last panel talked about private equity and private equity valuations, and there has been this debate, certainly in terms of whether or not assets are being correctly valued between private and public markets. Ross, you're active in that space. I know a lot of the investment trusts generally are trying to address this issue, that if you're able to sell your assets close to NAV values and you're trading at a significant discount to NAV, that's incredibly value accretive, but isn't the logical extension of that to just become private equity?
Well, as a fund manager who manages both private and publicly listed funds, we see both sides of it. And we also know that the assets that we've sold predominantly have been to private money as well, where we've sold solar assets that sort of some of the rock-backed subsidy assets that we know the listed fund couldn't afford to buy, because we just know that you won't be able to make the yields out of them. So we know our teams have sold them off to other privately backed money. Now, is it part of the flaw of what we do that there's so much, for the listed funds, there is so much so much release of information, so much disclosure out to the markets in terms of investment there, that actually you are limited in how aggressive you can necessarily go in terms of your pricing. Is it more flexible than private money that doesn't have to report as openly necessarily all the time is able to get away with offering higher prices? They're the same assets at the end of the day. We know what yields they can make or what they can't. So somebody's definitely willing to pay more for those. Does it make us change the model necessarily? I think at the end of the day, if there starts that, it's the macro picture as well. And I go back to that disconnect between the yield. I think if we start to see some modest cuts in interest rates in the way coming forward, I think we're starting to see, I won't even use the word green shoots, but we're starting to see some investors, particularly value-add investors, coming into looking around the portfolios and things like that. I think if you start to see some rate cuts, again, we don't think it's going to be significant, but if you start getting the gilt rates down a percent or two of a path to that, you may see a bit of a herd mentality coming back and that light bulb going, oh, we're not getting the same in fixed income, and there's a growth story here, and there's inflation linkage. I think we've just got to, as James says as well, we've just got to keep beating that drum until the penny finally drops at some point.
James, do you want to beat that drum as well?
Yeah, I mean, we talk about NAVs and things, but it's quite interesting that the only renewable energy companies that produce a NAV are, of course, the investment companies or the yieldcos. I mean, Ørsted doesn't produce a NAV because it has a net asset value on its balance sheet based on historical cost accounting. So it's quite interesting that we have these NAVs because we have effectively a company that's saying, look, this is what our assets are worth based on third-party estimates of what future power prices will be, based on our own knowledge of what our cost base is and how the assets, how long they'll last. So you're getting a good steer there of how all these various multiples feed into what should be the share price, effectively, because the biggest components are, of course, the power price, interest rates, inflation, and output. Yet we're all just focused on interest rates and we're ignoring everything else. And I can make a really good case for power prices, particularly like in the UK, for instance, where we are very reliant on France for electricity, a country which produces 3/4 of its power from a fleet of quite old nuclear power stations, which have proved to be quite unreliable. Well, you're selling power in a market that could quite quickly find itself very short of power. But that optionality is not reflected in the share price.
Conscious of time, and also we are the last panel before lunch. So I'll open up to questions. I think Lucy has a microphone. The first hand was, I think, just one down the back there, actually, or we start at the back and then we'll come forward.
Hello, it's working, by the way.
Yes, we can hear that. Yeah.
Okay, good. So Graham Cooley, I was the former CEO of ITM Power for 13 years, currently non-exec director of Cadent Gas. What do I want for Christmas? So cost versus policy. Actually, what we need is a properly integrated industrial strategy, because the only idea the government have got for decarbonising industry is closing it down. We need to take our technology companies. We've got fantastic technology companies in the UK. I disagree with what you said about innovation. We're good at funding it in the UK. What we're rubbish at is taking an innovative product and giving those companies enough money to produce their first production line and actually manufacture products and export them. So if you have a proper industrial strategy, rather than just an isolated energy policy, you make a big difference.
I don't know if anybody's got any comments on that, or we had another question. Yes, sorry, just here in the front.
I'm hoping this isn't going to sound very confusing. It seems to be that renewables are unreliable, therefore we need battery backup. What we hear in the press is that everything is priced with marginal cost is gas. Therefore, our electricity prices have been extremely unreliable. The EV rollout is therefore slow. heat replacement for gas boilers in our homes is slow. There's something wrong with the grid connection issue, and I'm afraid the marginal cost of power has been on the back of gas prices. It's left everything so volatile for the customer that I think that's why, as an investor, it's unreliable. Because the pricing is so. There are battery producers. There's battery storage that isn't connected to the grid. You're bringing wind power and solar power on stream supposedly, but it's not connected to the grid. There's something really fundamentally wrong with this. If neither the customer nor the investor can rely on what the infrastructure process. I'm sorry, that's a really complicated way of thinking.
I don't think it's complicated at all. In fact, I think people will largely agree, and we haven't spoken much about battery energy storage. We don't have we have people who invest in it naturally, but we don't have a dedicated battery energy storage play here. I think their wish for Christmas would be a sustainable high gas price rather than killing the marginal markets in battery energy storage. But that issue of storage and infrastructure is one that's significant for, I think, the rest of the industry.
Yeah. I'm happy to sort of tackle part of that as in terms of the reliability of renewables. I think there's parts of it I agree with what you said, and parts that I will disagree with a little, and I think it depends what you're reading in terms of, I think renewable assets can be very reliable when they are actually supposed to work. So if you're looking at solar, it is one of the most reliable technologies out there.
The sun doesn't shine at night, and it doesn't shine
Yes.
in winter, and most of the time.
Yes, but if the projects are built with that in mind, we're not expecting to produce during the night or significantly during the winter. Days like this, they will be producing. And I think it goes for wind as well. The North Sea is one of the best places in the world to build offshore wind turbines. But I completely agree with you in terms of being able to harness that energy. But we generated our highest amount ever last year, and it is actually going into the grid and being used. I think the biggest challenge we've got here in the UK, and it's not just the UK, all countries across Europe are saying this, how do you bring this technology into what you had was a smaller number of large power stations, and I think everyone has agreed that coal should be rolling off now and has done, but how do you integrate this more intermittent technology? And it's the grid that needs to be upgraded to actually do that. And battery storage is a big part of that. So we look quite closely at battery storage. Part of the issue is the system. So there are all these battery storage projects being built there. Part of one of the really frustrating things is they're actually being skipped over by the system operator at the moment. So it's actually, I think the technology is being built. There are teething issues along the way, but it needs properly integrating into the grid to be able to help. But it's part of a wider mix as well. But I'll look at it.
I mean, I think what I heard across the two questions was we've got a systems issue, right? We've got what we're talking about is unprecedented, and there's a whole multiplicity of agents within that system that need to be coordinated, and we're finding it hard. And I don't think it's a finger-pointing exercise. I think it's just a recognition that you need a supply chain, that you need a vibrant developer community that can meet its hurdle rates, that you've got a government that's out there providing the incentives and debottlenecking some of the infrastructure constraints and such like, and you've got a vibrant downstream, which is I think the point made in the first question, and I think they're difficult. They're all individually difficult, and they're collectively even harder, right? So I think sort of saying that it's easy and we can fix it, we can fix it, but I think there will be some lumps and bumps along the road. I'm quite sensitive to the downstream point. Actually, I think it's a really good one. We've thought about carbon, at least from a policymaker's perspective, on a kind of production-based view, right? And what we've done with rising unit costs, capex, relatively higher energy costs, is we've lost our downstream substantively. And I think now we're reflecting on that in light of more challenging geopolitical environments and such like. And I agree, it's going to take quite a lot to steer that ship, but it's fundamental. And I think, these kind of assumptions really matter for power prices. If you think about German industrial demand, right, it's absolutely critical for pulling units from across our portfolio. And frankly, the energy-intensive sector in Germany is 20% down on a production basis over the last 2 years, give or take, right? So, we're looking to the future where electrification is strong, but at the moment, our customers are on their knees. So, it's going to take some support and some strategic thinking to right that ship.
We have time for another question.
Thank you. The pace of innovation in this sector is obviously really quite high, which on the face of it is very encouraging. But how much does that pace of innovation create a problem for you in terms of the timing of investment decisions? I mean, I'm looking at it in a rather simplistic way. Those people who say, I won't buy an electric car this year, I'll wait till next year when the range has gone up. How much is that pace causing you a problem as to when you time your investments?
It's a good question, and it's certainly one that's relevant. We have two relatively mature, I don't mean to say that in an insulting way, but solar and wind are relatively mature as technologies in the space. I mean, but does it change the way that the investment timing is made? I guess solar has been really rapid.
Yeah, and I think there's solar, looking at that, and even battery storage and storage in general, maybe want to touch on as well. So solar I see as more of a evolution in terms of this. I think we're not necessarily seeing those sort of step change where you're going to go to a completely different type of sort of solar panel at the moment. The panel's getting more and more efficient. So that's the thing, we just have to believe in the levels of efficiency that we're seeing with the new kit that is coming in and looking at that supply chain. I think they're going to fundamentally change how the use of solar panels. You're getting bifacial ones where you can get the sun on both sides with it bouncing off the ground and things like that. I think it's just an efficiency play, and we will look at it in terms of the technology available at that time and at that decision point, because we're looking at that asset, and they won't necessarily be the same solar panels in 30 to 40 years time, because you will be replacing them. It might end up a bit like Trigger's broom, but actually you do expect them to sort of last for a long period of time, and if it's in that original investment case. I think battery storage is an interesting one, because there are a lot of other technologies that is predominantly based on lithium ion at the moment, a lot of which is there's only certain parts of the world that have those supplies. There are a lot of other technologies out there as well, but what you tend to need to do is to get those projects sort of bankable and in the where large money is comfortable with the technology to really invest in it. I mean, there's basically batteries out there that you can make of sodium now, which is effectively far more abundant than lithium, but it's getting that proof of technology and bringing it through. So I think at the moment, yeah, we may be looking at a shorter term time horizon in terms of the battery storage, just because of the rate of change in that market. It's a good question.
Yeah, look, timing matters in infrastructure investment. I think we all know that, or at least we should do. I think in a consistent cost out environment where markets mature, macro environment stable, maybe it matters a bit less, and actually it's about just finding the next high grade project to reinvest dividends into. I think we're entering a phase maybe where, as investors, I think we're going to have to be a little bit more tactical, and that's maybe as much about policy terms and short-term concessions from governments, etc., than perhaps the near-term pace of innovation. But I think outside our sort of outside our core sector and into the adjacencies, I think hydrogen and synthetic fuels is another one I think I'd point to where the pace of innovation really is going to be critical. And I think there is that sort of that valley of death where you're sort of looking to go long, but the proof of concept is kind of not fully complete or not fully verified, and there I think you are looking for a different set of risk sharing arrangements in order that you can spur that innovation, take some initial profits, and then start to scale market. So I think actually, e-fuels is another area where I think we'd be looking to the science base and to government to find an accommodation to get this going.
think we are done for time, actually. I'm just going to call for one last question, but no, I've been ruled out. It just leaves me to thank Ross, Ben, and James for their time today. So thank you very much.